Here's a question that gets asked a lot. How many stocks should I own? You're probably going to think I'll answer this with one of those sarcastic type answers like, wow, how long is a piece of string? But I do have an actual answer. It's 20. 20 stocks in your portfolio. So how did I come to that conclusion? And why do I pretty much just ignore it? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. First off, let's talk about the importance of diversification, or in other words, the reasons why you should probably have more than one stock. It's pretty much a cliche at this point, but to better understand diversification, consider the analogy of having all your eggs in one basket. If you carry all your eggs in a single basket and accidentally drop it, you stand to lose all of your eggs. Split the eggs between two baskets, and if you drop one basket, then you've only lost half instead. Similarly, if you invest all your money into a single company and that company experiences a downturn, your investment may suffer. However, by spreading your investments across different companies and different sectors, you're effectively distributing your risk just as you would if you carried multiple baskets for your eggs. If one basket falls, you still have other baskets to rely on. So we don't want just one company or one stock, as that would be a bit of a disaster if we dropped that basket. And that means we want more than one company in our portfolio ideally. But this then begs the question, is it a case that more stocks are better? Or is there a point where adding more doesn't really move the needle of risk anymore? Well, according to modern portfolio theory, there's a point where adding more stocks doesn't really reduce your market risk, or the risk that you get from investing in the market in the first place, and it's about 20. Let's take a look. If we look at the axes of this chart from Investopedia, the standard deviation, or the risk of the portfolio, is on the y-axis, so the higher it goes, the more risk, and the lower it goes, the less risk. And then on the x-axis, it's the number of stocks in your portfolio. So as it moves further away from the start, it's a portfolio with more and more stocks. When you start, you have one stock, and the risk is the highest that it will be. Then, if you add another stock, the risk jumps quite a fair bit down, and you become slightly more diversified. Add another stock, and it drops down. Add a stock, drops down. But as this goes on, you eventually get to the point where the next stock that you add makes so little difference to the risk of your portfolio return that it doesn't really help much, and many people say that point is around 20. Again, looking at the graph, there's a level of risk that just can't be diversified away. You see that up to the first white dotted line. And this is the reason why a lot of people will tell you need about 20 to 30 stocks, and not really more than that in a portfolio. It's exactly this theory that adding more and more doesn't diversify the market risk away. Adding more does bring with it problems though, and let me quickly go through a couple problems with having many stocks in your portfolio. The first is the cost. For a lot of investment platforms, building up a diversified portfolio can be a costly endeavour. If the broker charges £10 a trade and you follow this advice, then it's a bill of £200 before you even get started. And that's why I prefer to use a low-cost broker like Trading212, who have also kindly sponsored this video. On top of that, I asked Trading212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or are planning to open an account, and here it is, DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. The other issue with trying to build up a portfolio with all these stocks is managing and researching the holdings. Managing a portfolio of 20 stocks is challenging due to the need for thorough analysis and sheer volume of information. Each stock requires examination of factors like financial performance, industry trends, and management quality. This demands significant time and effort from investors. Furthermore, the abundance of stocks amplifies information overload. Keeping up with news, earnings reports, and analyst recommendations for all 20 stocks can be overwhelming. Investors must sift through a constant stream of data to make informed decisions, which requires efficient time management and information filtering. Overall, handling a portfolio of 20 stocks requires careful attention to time management and research techniques to overcome the challenges of information overload and make well-informed investment choices. This is also why it's often appealing to invest in a broad-based market ETF, as it offers diversification across a range of stocks, reducing the time and effort required for individual stock research, and mitigating the challenge of information overload. With just one investment instead, investors can gain exposure to a diversified portfolio, saving time and transaction costs compared to managing multiple stocks. If we look at an example, VWRL, it's only one stock for you to manage, but in fact it's 3,672 stocks all wrapped into one. So, if the research seems to think that you should have about 20 stocks, then why do I seem to ignore that as a dividend investor that is building a portfolio that pays your bills? Why does the Almost Daily Dividends portfolio have 50 stocks in? That's way more than the 20 touted. It's because there's another consideration when building a dividend portfolio, and that is diversity of payments. When you're planning to live off dividends, retiring on dividends, or paying for your minimum viable lifestyle, you want the payments to come in somewhat regular basis. If you compare it to a salary, if your boss paid you once per year, it's much harder to deal with that than being paid monthly or every 2 weeks. You want diversity of payment frequency. But not only that, you want diversity of payment sources too. A huge problem I see on Facebook groups is people see one stock with a huge yield and they think it's pretty good, and then they go all in on it. And this works fine until it doesn't. When that company cuts, your income is completely gone. Now, Almost Daily Dividends is an extreme case here, as the purpose of the pie is almost daily dividends, so it's going to need to have more stocks as just a simple requirement of getting that many payments in a year. It wouldn't be possible without a larger number of stocks. And here's the other big difference with dividend portfolios compared to the average stock portfolio, and I might get some pushback on this as it's quite a controversial point, but managing dividend stocks is easier. To show what I mean here, let's look at an energy infrastructure company in the UK, National Grid, which I think fits almost a perfect archetype of a natural dividend payer. You can check the news for this, check its earnings reports, and to be honest, not much is going to be happening quarter to quarter. Its share price volatility is relatively low because not much impacts it really. Now, if we compare it to another popular stock at the moment, Palantir, people can make entire YouTube channels just talking about this stock as there are new things happening almost every day to this company. How many national grids do you think you can manage? Now, how many Palantirs do you think you can manage? I hope the point that I've made is that the energy exerted to manage the type of stocks that are typically natural dividend payers is typically less than the energy required to manage and keep up with the research for stocks like Palantir, Tesla, Nvidia, and those types of stocks that are popular. So, in conclusion, to answer the question, how many stocks should you own in a portfolio? It turns out that it is the dreaded how long is a piece of string question after all. It depends on what kind of portfolio you want to build and the requirements of that goal portfolio. Whether you think you can deal with having a load of stocks that you then have to look after, or if you would rather achieve market level of undiversifiable risk with an ETF, what the companies you have in your portfolio already are and why you've got them already. And when you think about adding the next stock to your portfolio, think about whether it offers something that one of the stocks in your portfolio doesn't already give you. Is it really worth adding another stock if it's not helping out your diversification? Unfortunately, the answer is up to you to figure out. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the Almost Daily Dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!